Hey, good morning, everyone. It's Chris Weaver here with Atlantic Sotheby's International Realty, and I've got a great topic for you guys today. The topic is assumable mortgages. Assumable mortgages really should be a much hotter topic out there, and I'm surprised it's not all over media and all over the real estate channels because it's a way that a home buyer can save thousands every year on their home purchase, and it's also a way for a home seller to get more money for their home. So first, let's talk about what an assumable mortgage is. An assumable mortgage is where a buyer qualifies to take over the loan from a current seller of a property who has a VA or FHA loan. Those are the two loan types that are assumable, VA and FHA loans. And I'll go more into that later. A conventional loan is typically not assumable, and if you try to assume a conventional loan, you may trigger the due on sale clause. And the due on sale clause means that the lender, the current lender of the seller, can accelerate the debt, and then all of a sudden the new buyer finds himself owing the entire mortgage all in one payment. And I know for most of you guys out there, that's probably not something that you want to do. So you've got the two loan types that are assumable, FHA and VA. And I'll break those down really quick. So both you have to qualify. It's just like getting a normal loan. You have to turn in your income documents, you have to get a credit report, you have to make sure that you qualify for the payment. But you have to remember, if you were able to qualify for a $600,000 home at 7% or 7.25%, then you're probably going to be able to qualify for that home if the interest rate is down at 3.5%. So it's actually a way that you can qualify for more home and save a lot of money in the process. So secondly, if you're a home seller, you have to have been in the home typically for 1 year for you to qualify to do an assumption where you can do an assumption where you're going to give that loan over to the buyer. Okay, so you need to be in the property for about 1 year. So in a nutshell, that's the basics of an assumable loan. You have a buyer, you have a seller, the buyer takes over the seller's loan and then inherits that super low interest rate. Now, let's break down what that cost difference would be, and I wrote it over here on my board. So on a $500,000 loan at 3.25%, the payment, not the interest portion of the payment, would be $1,354 per month. Based on today's interest rates, the interest would be $2,700 per month. It's literally double, guys. So when you add the taxes, insurance, and everything else, you're probably looking at a total payment of about $2,000 for the assumed loan versus nearly $3,500 or $3,700. And this is for the exact same house. So pros and cons. So the pro for the buyer, it's pretty obvious. You're going to be taking over a loan that's got an interest rate as low as 2%, 2.5%, 3%, 3.5%. I mean, amazing interest rates. And if you can lock in something in the twos, those are interest rates that we're probably never going to see ever again. The other advantage that I think a lot of people don't think about is you're actually taking over the seller's amortization. So if their loan is 2 years old, 3 years old, 4 years old, 5 years old, your loan is also 4 or 5 years paid down. That means you're not taking on a 30-year loan. You're actually entering into a 27-year or 26 or 25-year loan. So you're actually ahead of the game already. And then, of course, from a cost standpoint, the lending fees are lower. There's no appraisal fee that you have to pay. So it's really a pretty huge advantage. Also, for home sellers, if this is marketed properly to the home buyers that are out there and you cast a wide enough net, which is something we can do over here at Atlantic Sotheby's International Realty, you are actually going to be able to get more for your home. I mean, think about it. The difference in interest between today's interest rate on a $500,000 loan and what it was on an assumable loan of $1,354, that example I gave you, that's right around, let's see, $1,400 a month. $1,400 a month times 12. So that's $20,000 roughly a year the buyer is saving. Now, why would a buyer not want to spend $5,000 or maybe even $10,000 more on your home if they're going to save $20,000 every year? I think the answer is pretty obvious. So anyway, that's the major pro for the home seller. Now let's talk about the cons. So one of the biggest cons, of course, is going to be the down payment for the buyer. So remember, these loans are paid down and there has been some home price appreciation. So if you're a buyer and you don't have any money, you have zero money to put down, this is probably not going to be an alternative for you. Now, if you have a little bit of money, say you've got 5% to put down, you can probably qualify for the seller's assumable loan, also take a second mortgage or a home equity line of credit from a new lender. So you'd have two loans, and you know what? I bet you the combined mortgage payment for the two loans is probably lower than if you went out to get a loan today. And of course, you'd be paying a much lower rate of interest on that primary loan. So anyway, that's a consideration for the buyer. The next consideration is, of course, the processing time. If you get a new loan, you're going to be able to process that deal and get it to closing in 3 or 4 weeks, which is the typical closing time. It's pretty awesome. If you're going to be doing an assumable loan, 3 or 4 weeks is going to be the best case scenario, and you're probably looking at 60, maybe even 70 days. If that works for all parties, then it's really not a problem at all. So that's one of the negatives for the buyer. Now, for the home seller, the only other negative that would be out there is if you have a VA loan and your buyer who's going to assume the property is not also a veteran with a VA entitlement, or they've already used their VA entitlement, then your entitlement may stay in the property. So anyway, and of course, here in Hampton Roads, that's not a problem because we have plenty of veterans, so that wouldn't be a problem at all. So anyway, one other thing that you've got to remember if you're a home seller is you want to make sure that you get a release from your current mortgage company, a release of liability. Now, this should be just something they include with their normal paperwork, but make sure you ask your lender for that release, or you might find yourself still on the hook for that loan. So anyway, there you have it. Assumptions are the deal. That's really, if you have the money to put down, that's really what you should be looking for. You're going to save yourself during the life of the loan hundreds of thousands of dollars. Why wouldn't you do it? If you're a home seller and you have a loan that's assumable, this is a great way to get more for your home. The market is changing, and we got to be a little bit more inventive and dig a little bit deeper. So anyway, there you have it, guys. If you guys have any questions on assumable loans, if you're an agent out there and you need to bounce some ideas off me, I'm happy to answer them for you. If you're a home buyer or seller, our agents over here at Atlantic Sotheby's International Realty are more than happy to assist you. Please direct message me. I'm happy to get you connected. I hope you guys all have a great week. Chris Weaver over here at Atlantic Sotheby's International Realty.